inflation is on the rise. That's obviously no secret. And what I oftentimes see investors do whenever inflation is rising is they'll put less value on dividends because they tell themselves that if the inflation rate is either the same or even higher than whatever dividend yield they're collecting, then what's the point of even owning that dividend stock in the first place? Because the dividend is just going to get canceled out by the inflation, or maybe even worse, you actually take a loss on that investment if you're just thinking about the dividend. However, that's the key word there, though, right? What these dividend critics oftentimes overlook, or I would say that they conveniently ignore, is the fact that a good company will also see their stock price go up over time. And so a dividend is just a nice added bonus on top of what you're already making through your investment. So in that sense, you can think of a dividend as actually a great hedge against inflation, or at least a great tool to combat it and to lower its impact that it would otherwise have on your portfolio. So I think dividends are a great thing to have during rising inflation. However, for all of that stuff to work out in our favor, we need to have good, solid companies that can perform well even during a recession, even during weak economic times, so that they don't have to cut their dividend and so that they don't suffer any long-term negative effects on their business. So in today's video, I'm going to give you guys 4 different industries that I think will perform relatively well, better than other industries during the next recession, and I'm going to give you guys one dividend stock for each of them. And in case you don't like them, I'm also going to give you an alternative pick as well. So it's actually going to be 8 different dividend stocks in today's video, which is going to make for a very fun one. I hope you guys enjoyed. Hit the like button if you do, but we got a lot to cover, so let's get started. What's up, everyone? My name is Ale. Welcome back to my world of stocks. All right, let's go ahead and start by just quickly listing off the 4 different industries. I'll give you a dividend pick and I'll give you an alternative dividend pick as well to consider for the long term. Let's jump into it. All right, so running through the industries, we've got utilities, because even during difficult economic times, there tends to still be plenty of consumption and demand for electricity, gas, water, and even waste management, which leaves utility companies performing relatively well compared to the rest of the market. For industry number 2, we're going to go with healthcare, since people don't just magically stop needing medicine or other health services during a recession. Granted, they may try to avoid certain procedures if they cost too much, but at the end of the day, if you're trying to limit your spending, you'll likely have your own health at the top of your priorities list during difficult economic times, and certainly above non-essential expenses like leisurely activities or luxury items. For industry number 3, though, I'm going to go with consumer staples, because just like you need your basic medicine, you're also going to need your basic essentials and household supplies, your cleaning supplies, your food, your hygiene products, so on and so forth. And finally, for industry number 4, I'm going to go with discount retail. Just like you need your consumer staples, you still need a place to actually purchase them, and during difficult economic times, you're going to be much less likely to shop at the mall or even slightly higher end grocery stores like Albertsons or whatever you want to call it, but instead you're going to go to wherever you can find the cheaper price, and so discount retail will be that last industry. Okay, now starting with the first industry, that's going to be utilities, and normally I would go with NextEra Energy, ticker symbol NEE. That's actually my alternative pick for this industry, and I'll explain why in just a second. But I've often talked about them a lot on the channel, and I've always found them intriguing for various reasons. First of all, they're the largest utility company by market cap in the entire world at over $155 billion versus the next closest competitor in Duke Energy all the way down to just $81 billion, so almost half the size. And because they're a utility, they benefit from a combination of regulated rates along with long-term contracts on their electricity that leaves them with more dependable cash flows over the long term. But the great thing about NextEra is that they also have a renewable energy segment that, when combined with their subsidiaries and partnerships, it's turned NextEra into the largest wind and solar energy producer in the entire world, which also helps bring in growth for what you would otherwise expect to be a typical low-growth utility. In fact, over the past 10 years, NextEra has averaged EPS growth of almost 10%, while the other top 10 power companies only achieved around 3% growth during the same time, and the future looks just as bright. This past year, they increased their renewable contracts backlog by around 25%, which, according to Allied Market Research, the global renewable energy market is expected to reach nearly $2 trillion by 2030. But this is why my pick for this industry is actually NextEra's renewable subsidiary called NextEra Energy Partners, ticker symbol NEP. Again, NEE is a great choice too, and I'm picking them as my alternative, but NEP is a higher growth with a larger dividend. NextEra Energy pays around a 2% yield, while NextEra Energy Partners pays over 3.5% with a 15% growth rate to go along with it. Sales even climbed during the 2020 recession by a double-digit percentage, still managed to climb again in 2021 by another 7%. It's expected to skyrocket by over 40% this year and then still do double digits in 2023 as well. That's phenomenal growth. Unfortunately, both stocks are never really cheap, and I actually think that they might go down more in the short term before climbing higher over the long term, just because of rising interest rates that will hurt NextEra's profitability, since they do rely so heavily on investment and debt and acquisitions. But considering that NEP is already near the midpoint of its 52-week range, if it was to fall any more from here, and especially if it were to crash all the way down to the lows, I just think both stocks would be an amazing pickup for the long term, considering the stable demand for electricity, the huge growth in renewables, and the really nice dividends that I don't think will go away anytime soon, even during a recession. By the way, NextEra Energy, ticker symbol NEE, is in a very similar position stock-wise, as you can see right here. All right. Moving on now to the next industry, number 2, that's going to be healthcare. And for this one, I'll start with Johnson & Johnson, ticker symbol JNJ, as my primary pick, whose stock has been suppressed over the years because of lawsuits and controversies, leaving it up only about 35% in the past 5 years. But they have numerous household brands and products across various sectors that people will pretty much always be buying. For example, they have pharmaceuticals like Benadryl and Tylenol. People, still get headaches during recessions, probably even more so. There's healthcare and hygiene like Band-Aid, Listerine, and various lotions and powders. Still got to keep those teeth clean during difficult times. There's vision products like AccuView. You still got to be able to see. There's tons of medical devices, and admittedly, those sales probably will go down during a recession because hospitals do tend to cut their budgets during difficult times. But I just think that they're so well diversified. I mean, they even have a V shot for the pepperoni, which also admittedly makes way less money than Pfizer and Moderna because of controversies, but it's still been able to generate billions of dollars for them in sales too. Anyway, the point is that because people still need healthcare products and services during all kinds of different economic conditions, J&J sales have been able to actually increase slightly during the 2020 recession. They increased again by a whopping 14% during a weak 2021 year, and they are still expected to grow by another 6% and 2% in each of the following 2 years respectively as well. And then the biggest benefit of all with J&J is the super attractive dividend that yields about 2.5% with a payout ratio of less than 50% and an absolutely massive growth history of almost 6 decades in a row. You can slice it however way you want, but no matter how bad the economy gets, that dividend is almost certainly not going to get cut during the next recession. For me, however, in this category specifically, I actually prefer Merck, ticker symbol MRK, who I'm going to put as my alternative pick, just because I do think that most people would be better off with a safer option like J&J. But for anyone wanting a little more risk with a higher paying dividend like I do, then Merck is also a great choice. They're a very large biotech pharmaceutical company, and I've been buying it recently for their really nice dividend that yields over 3.5%, with a still very stable business overall, lots of blockbuster drugs, and a huge pipeline for the future to top it all off. The stock is even cheap, currently sitting in the bottom half of its 52-week range with a valuation that is around 50% cheaper than the sector. Again, both are solid picks in my opinion, as long as you're thinking long term, but those are the two I'm going with. All right, now moving on to the next industry, we're going to go with consumer staples at number 3. And if you thought that J&J had a huge dividend growth history, then consider this next one because it's even larger than that. And that is, of course, Procter & Gamble, ticker symbol PG, as my primary pick, who has increased their dividend by a whopping 65 years in a row. That is massive. And the way they've been able to do that is by selling some of the most popular brands and products in the world. You're talking Charmin toilet paper, Bounty towels, Gain, Tide, and Dawn detergents, Gillette shaving, Crest and Oral-B dental, Febreze and Downy deodorizer and fragrance, Pampers diapers, Always and Tampad, you know what? You've got NyQuil, you've got Head and Shoulders, you even have Duracell batteries, you've got Pringles chips, and Iams dog food. I mean, the list just goes on and on. And that's resulted in massive sales for them of over 70 billion per year, and they still managed to grow by 5% during the 2020 recession, another 7% in 2021, and are still expected to grow by about 5% a year after that as well. Even their profits as EPS are expected to grow more in the next 5 years than the previous 5. The stock is not cheap valuation wise, but it is at least slightly below the midpoint of its 52-week range. And when you add up all those different household brands with an absolutely fantastic dividend, I just think it makes sense for a pretty solid long-term stock. Granted, the dividend yield is a little low at 2.4%, but if you want something that's just a little bit higher with still a very large growth history and some very popular brands to go along with it, then I would also take a look at PepsiCo, ticker symbol PEP, which is a stock that I own myself, and that'll be our alternative pick. It's trading pretty high, but it also is at least near the midpoint of its 52-week range, leaving the dividend pretty attractive at a 2.8% yield with a massive almost 5 decades in a row of growth. Both stocks I think are solid, long-term options, especially because of their giant size that allows them to acquire smaller competitors and remain dominant, which they've done many times in the past. It's really helped them maintain their market share. Anyway, moving on now to the fourth and final industry. We just spoke a lot about household goods and groceries, but of course, to have those things, you first need to buy them from a retailer. And so, looking at low cost retail options, I actually really wanted to go with Amazon above anything else, just because even during a recession, I think a ton of people will be using online shopping to look for cheaper prices, which Amazon is really notorious for providing. But because this is a more dividend focused video, I'm actually going to go with a company that offers the best of both worlds: low cost brick and mortar retail combined with low cost online shopping. And for that, I'm going with Walmart, ticker symbol WMT. And when you look at it, Walmart owns and operates around 10,500 different stores across 24 different countries, with many of them being almost warehouse-like in size that sell practically everything you might need, and many of those products are even discount brands that are heavily relied on during weak economic times. There's just very few companies out there that can rival Walmart's massive size and their economy of scale that allows them to charge such low prices. And they also utilize that physical footprint to offer online pickup and returns, since close to 90% of the US population lives within 10 miles of physical Walmart stores. Speaking of online sales though, Walmart is probably the biggest competitor to Amazon here in the States, as their website already sees about 100 million unique visitors per month. They have the second most online shopping market share in the US, only behind Amazon, although admittedly it's not even close, like Amazon is way ahead of them. But because of the global health issue that really sped up, adoption of e-commerce, Walmart's online sales have more than doubled since 2020, which is pretty impressive. Speaking of sales, their total revenue grew by 7% during the 2020 recession and another 3% in every year following. Granted, 3% is pretty low growth, but this is a company that already does over $500 billion in sales. That's $500 billion. I mean, what other companies can match that size? Anyway, with a company like this, you're obviously going to get some very nice dividends. The stock is not cheap. It's currently up over 100% in the past 5 years and only around 5% away from an all-time high. But it's not really a stock that dips very much, and despite that, you still get a fairly decent dividend of over 1.5%. It's not that big, but it has at least been grown for almost 5 decades in a row, which is very, reliable. If you're looking for something a little larger though, then you might want to consider my alternative pick, which would be Home Depot, ticker symbol HD, who is also up over 100% in the past 5 years, but a most recent dip of close to 25% has left their dividend yield a bit higher at around 2.4%, with some really nice growth metrics on it, like a payout ratio of less than 50%, 13 years of consecutive growth, and a super nice growth rate of over 18%. I mean, that's pretty close to 20% growth rate. That is really good. And the nice thing is that during a recession, a lot of people tend to do many projects themselves to save money. And most of the time, they'll have to shop at places like Home Depot for many of their resources and tools that they need. Not exactly recession proof, but I think that Dividend will likely stick around and sales will probably be more stable than most other companies, even during some difficult times. Anyway, that does it for today's video. Let me know what you guys think down below in the comment section about all these different stocks. Do you like any of them? Do you own any of them? Are there any so-called recession-proof stocks that you think I should have talked about in today's video? Let me know that down below in the comment section. Maybe I can make a future video on that as well. But thank you so much for stopping by. Thank you for supporting the channel. It means the world to me. Hope you're all doing well out there. Now we'll catch you in the next video. Take care. Bye-bye.